Investment strategies for beginners. The best investing strategies increase returns, minimize risk, and meet your goals. Find the strategy that's right for you. What's an investment strategy? An investment strategy is a way of thinking that shapes how you select the investments in your portfolio. The best strategies should help you meet your financial goals and grow your wealth while maintaining a level of risk that lets you sleep at night. The strategy you choose may influence everything from what types of assets you have to how you approach buying and selling those assets. If you're ready to start investing, a good rule of thumb is to ask yourself some basic questions. What are your goals? How much time until you retire? How comfortable are you with risk? Do you know how much you want to invest in stocks, bonds, or an alternative? This is where investment strategies come into play. Popular investment strategies. There are numerous ways to approach investing, and here are some of the more popular investing strategies to consider. 1. Start with a new or existing retirement account. One way to begin investing is through a retirement account. Open or access an individual retirement account, or IRA, through a brokerage account. Then choose investments that are aligned with your goals. If you already have a retirement account through your employer, it's generally a good idea to contribute to that 401k first and qualify for the company match before you start funding your IRA. Employer match programs are free money you don't want to leave on the table. However, you should know that most 401ks offer relatively few investment choices, so the options for strategy within those vehicles are usually limited. Whereas IRAs give you access to a more expansive world of investments than your 401k may offer. 2. Buy and hold investing. It's always nice when things have a clear label, and you can't get much clearer than buy and hold. Buy and hold strategists seek investments they believe will perform well over many years. The idea is to not get rattled when the market dips or drops in the short term, but to hold on to your investments and stay the course. Buy and hold works only if investors believe in their investments' long-term potential through those short-term declines. This strategy requires investors to carefully evaluate their investments, whether they are broad index funds or a rising young stock, for their long-term growth prospects up front. But once this initial work is done, holding investments saves time you would have spent trading, and often beats the returns of more active trading strategies. 3. Active investing. Active investors prefer trading more frequently and opportunistically to capitalize on market fluctuations. Stock traders may use technical analysis, the study of past market data such as trading volume or price trends, to help anticipate where market prices might go. Active trading includes different strategies based upon pricing, such as swing or spread trading, and can also include momentum and event-driven strategies. Momentum investing seeks to identify and follow trends currently in favor to profit off of market sentiment. Event-driven investing strategies attempt to capture pricing differences during corporate changes and events, such as during mergers and acquisitions. 4. Dollar cost averaging. The biggest challenge to timing the markets is getting it right on a consistent basis. For those investors wary of trying their luck on market timing but still wanting a good entry point into the market, the strategy of dollar cost averaging may appeal. Investors who dollar cost average their way into the market spread their stock or fund purchases out over time, buying the same amount at regular intervals. Doing so helps to smooth out the purchase price over time, as you purchase more shares when the stock price is down and buy less shares when the stock price is up. Over time, you gain a better average entry price and reduce the impact of market volatility on your portfolio. 5. Index investing. While there are active and passive approaches to investing, there are also active and passive investments themselves when deciding between various types of funds. Investors frequently use mutual funds, index funds, and exchange-traded funds, ETFs, to populate their investment portfolio because funds provide access to a collection of securities, generally stocks and bonds, through one vehicle. Funds allow investors to benefit from diversification, spreading investment risk across many securities to help balance volatility. Active funds employ a portfolio or fund manager to handpick certain investments to populate the fund based upon proprietary research, analysis, and forecasts. The manager's goal is to outperform the fund's corresponding index or benchmark. Passive funds, such as index funds and most ETFs, simply mimic an underlying index, providing the investor with similar performance to that particular index. 6. Growth investing. Growth investing involves buying shares of emerging companies that appear poised to grow at an above-average pace in the future. Companies like this often offer a unique product or service that competitors can't easily duplicate. While growth stocks are far from a sure thing, their allure is that they might grow in value much faster than established stocks if the underlying business takes off. Growth investors are willing to pay a premium price for these stocks in exchange for their robust future growth potential. New technologies often fall into this category. For example, if someone believes that homebuyers are going to shift increasingly from banks to online mortgage lenders with a streamlined application process, investors can also look toward burgeoning geographies or companies to find growth. As they industrialize, emerging markets or developing economies usually are more volatile but also grow at a faster pace compared to their more developed peers. Companies are valued by market capitalization, or market cap, which is calculated by their total outstanding shares available times the market price of the shares. 7. Value investing. Made famous by investors such as Warren Buffett, value investing is the bargain shopping of investment strategies. By purchasing what they believe to be undervalued stocks with strong long-term prospects, value investors aim to reap the rewards when the companies achieve their true potential in the years ahead. Value investing usually requires a pretty active hand, someone who is willing to watch the market and news for clues on which stocks are undervalued at any given time. Think about it like this. A value investor might scoop up shares of a historically successful car company when its stock price drops following the release of an awful new model. 8. Income investing. Investment strategies can help investors achieve a particular aim, for instance, producing a steady income stream. Many investors use income investing to help cover their living expenses, particularly when transitioning into retirement. There are different investments that can produce income, from dividend-paying stocks to bond and CD ladders to real estate. 9. Socially responsible investing. Social issues such as climate change and racial justice impact lives on a day-to-day basis. Socially responsible investing, SRI, aims to create positive change in society while also generating positive returns. In addition to investment performance, SRI investors look into a company's business practices and revenue sources to ensure they're aligned with their personal values. If you find this video useful, don't forget to like and subscribe to our channel.